Well, good morning, everyone. It is 11 o'clock Central Time, noon Eastern Time, and we're going to get started with our Red Team webinar for today on WIP reporting and how to track progress and profitability of your projects. As we get started this morning, I do want to point out a couple of things on your Zoom webinar toolbar. If you're newer to a Zoom meeting, you do have a chat feature. So if at any point during our conversation this morning, you want to send in some questions for Michael and I to answer, please do that. You can open up your Zoom toolbar and click on the chat icon and send those in. We will take some time for Q&A and answer those questions as we go through the conversation today. But today you are going to have Michael and myself. My name is Tracy Van Dalsum. I am the Vice President of Red Team Go, and Michael Wright is the founder of Red Team, currently sitting in our Chief Strategy Officer role here with the company. And we're excited to talk to you about WIP schedules. We know that they are vital to our companies and our projects as we're moving along in the process of construction. And we wanted to spend some special time going over those with you today. So on the agenda, we're going to talk about what a WIP schedule is, how to prepare a WIP schedule, and keeping it up to date and current with all the project costs that are happening on your projects across the company. So we're going to talk a little bit about what a WIP schedule is. So Mike, we're going to do this a little bit interview style between Mike and myself. So we're going to have Mike explain a little bit about what the WIP schedule is. So Mike, tell us a little bit, just high level, what the WIP schedule is and why it's so important.
Of course. And Tracy, thanks for handling the heavy lifting on the introduction and getting us up and running here on today's webinar. I always appreciate that. You do such a great job at the startup. So what is a WIP schedule? This is quite honestly, this is one of my favorite topics to discuss. And it's not just because I spent 10 years in accounting and finance before getting into the commercial construction business. I do love it because, for that reason, but I also love it because this is the language of business that we're talking about. And so let's just start off right out of the gate with a definition. What is a WIP schedule? So WIP stands for work in progress. And work in progress, those are some pretty generic words in our industry, and it's easy to get those conflated with a number of other things, that we get involved with on a day-to-day basis as commercial contractors. But the work in progress schedule that we're going to be talking about today is uniquely and specifically related to financial reporting. And that's an important distinction because a WIP schedule has a very specific definition from an accounting and finance perspective. And this is the WIP schedule that you would discuss with your bankers, perhaps with your insurance company, and most importantly, your surety. And so while we might talk about work in progress from a number of different perspectives, from this perspective, and the topic of today's conversation is specifically the version of the WIP schedule that we use for financial reporting and for discussing financial performance, working capital management, cash flow. It's super valuable to have a WIP schedule. And so let's jump right into it. So first and foremost, we use a WIP schedule to calculate something called percentage of completion. This again sounds like it could be applicable to evaluating a billing from a subcontractor or a supplier, or for handling our own progress billing to a project owner. But in this case, percentage of completion is calculated in a very specific way, and that specific methodology is actually prescribed by something called generally accepted accounting principles. And if you really want to dive into the weeds, we might even talk about ASC 606, which was the accounting industry's attempt to kind of standardize the way people recognize revenue on projects, particularly long-term projects that span multiple accounting years. But I think that's probably a little bit beyond the scope of today's discussion. But to put it very simply, percentage of completion on a typical WIP schedule is going to be based on actual costs incurred to date divided by the estimated costs at complete. And so if I could just make an example here, if you have a specific line item or a project with $100,000 of estimated cost at complete, and you've expended $50,000 of that $100,000, the accountants would say you are 50% complete. And we'll talk about some examples in a few moments here where percentage of completion could be some very different number as determined by other folks for different purposes. You know, some of those other folks might include an inspector from a construction lender or an architect or your subcontractor, the way they measure their percentage of completion. And so, as you can imagine, you can get lots of different numbers, but from a financial reporting perspective, percentage of completion is specifically based on cost to date divided by estimated cost at complete. The way we use that percentage, we actually use that percentage to make a determination as to how much has been earned on a particular contract or project. So in my example, we've spent 50% of the money estimated at complete. And so the accountants would say you have earned 50% of the contract value. And we're going to keep things simple today. So we're not going to talk about maybe the difference between cost and price. But so we're going to say, let's say we're a construction manager and the overhead and the fee and general conditions and general requirements are all itemized separately. And so our cost in this case is the same as our price to the owner. And so in this particular example, we would be 50% complete for this contract line item.
Mhm.
We take that 50% and then that's used to then calculate what we call revenue or revenue recognition. Now that we know the revenue and we have the cost, that tells us our profit, and it also tells us what remains to be completed on the contracts in progress, and that's called backlog. Very, very important numbers. This is the language that your surety speaks, and it's the language they expect you to share with them so that you can be on the same page, understanding the status of the business.
I want to talk about that surety and bonding a little bit more, Mike. How do surety and bonding companies utilize the WIP schedule? Like why is this important for us to be able to give to our surety and bonding companies? And what do we have to provide it to them for?
Well, as you know, sureties want very tough guarantees by the owners of every construction company that they choose to back. And so they're constantly inspecting financial statements. And what's really interesting is, you know, the first page of a typical financial statement is usually something called a balance sheet. And I've sat with sureties so many times. Oftentimes they skip the first page, they skip the second page, which is the income statement, and they go right to the work in progress schedule. Because the work in progress schedule really tells them and explains the story of how the business is doing financially. It represents where you stand from a performance standpoint, showing revenue recognition and profit by project. And one of the more important numbers on there is the backlog number. Oftentimes the sureties will refer to that as work on hand. Essentially, it's the value of your contracts that haven't yet been performed. So that's a very important number that they like to track because they have certain limitations on the way they underwrite each contractor's account. Oftentimes, the backlog or the work program that the surety supports will be a function of the contractor's net book value. Usually, there's a multiplier on net book value, and that gives them a total amount of work on hand that they can support. So what they're always looking at is where does the contractor's backlog sit relative to the total amount they're willing to back financially. So that's one of the first things they look at. Um, the second thing they're going to really scrutinize is over under billing by project. And
Mhm.
if there's anyone on the call that isn't familiar with over or under billing, this occurs when you've got an amount billed to a client that may in fact be different than the amount you've actually earned from a financial reporting standpoint. So if I could go back to my $100,000 example, let's say that was $100,000 for 10 windows. And let's say those 10 windows were procured and contracted by the general contractor. 5 of them were $1,000 a piece, and another 5 of them were $19,000 a piece. It's 10 windows with $100,000 scheduled value on the prime contract. And let's say the 5 windows installed happen to be the $1,000 windows. And the architect walks the project and they say, well, you've completed 5 of 10 windows. We're declaring it 50% complete. But in fact, the accountants know that you're only paying $5,000 for each of those windows. And so the accountants are saying, well, you're only 5% complete on that line, on that particular line item. The architect just gave you credit for 50% complete. Well, that's a cash flow windfall for the contractor because the owner is about to disperse $50,000 for which the contractor is going to pay $5,000 to the subcontractor. And so that might be a good situation. It's usually not that extreme. However, the numbers could be reversed if the windows were different. Let's say you installed the expensive windows, the $19,000 per window scope. You could actually be $95,000 out of pocket and only getting $50,000 from the owner. And so there's a $45,000 shortfall just on that one line item. And so somebody in the accounting department is going to be probably a little bit hot under the collar because that creates a cash flow issue for the project that maybe wasn't expected. But from a surety's perspective, they're very interested in looking at the over and the under billing. And there's lots of stories they can tell about why something is over or under billed. And generally, they expect the contractor to have a very good explanation of why something might be overbilled or underbilled.
Yeah. Yep. All right, I'm going to move us into talking about some specific components of a WIP schedule. We've already talked a lot about some terminology that we've used of estimated cost to complete and billings and over under. What does it mean to use a percentage of completion? Can you be a little bit specific on, I know we just talked about that just a little bit, but how does
Yeah, we talked about the calculation. So, I mean, some of the key inputs on your WIP schedule here, I'm going to just go back a second and say, the vast majority of we've spoken to probably thousands of contractors at this point in my career, plus 30 years as a commercial general contractor. I've had countless conversations about WIP schedules, not just my own, but talking with Red Team clients about they handle their WIP schedules, how they actually calculate and produce them. The vast majority of contractors actually do this on spreadsheets. And at Red Team, we're trying to change that. We're trying to move people onto a platform in order to manage WIP schedules, just because the time savings and the increased accuracy create a lot of value for our client contractors. But nevertheless, don't feel bad if you're still doing this on a spreadsheet because I've told this story, Tracy's heard this before, only one time in the last 30 years have I met a contractor who was not on Red Team already that was able to do a WIP schedule on their accounting system. The reality is there are so many inputs that have to be entered to make the calculations on the WIP schedule that it just doesn't lend itself to being something that's buried in an accounting system silo. And so inevitably it ends up getting put onto a spreadsheet. But some of the external inputs to your WIP schedule include things like contract values. That's pretty self-explanatory. Contract values is the value of your prime contract. whatever the base contract is and whatever the change orders are. You sum all that together, and that's the contract value for a project. And you have to have the contract values for all of your projects in progress on your WIP schedule. Estimates at complete, it's a very fancy term for the estimated cost at complete. And so this falls into the domain of the project team to really understand what their costs are by the time they finish the project. When you have a structured system to manage EACs, it's super helpful for the project team. And we'll talk about that process when we get to how you actually prepare a WIP schedule.
Well, an estimated cost complete are a little bit there. That's different than actuals, right?
It's very different than actuals. This is predicting what your cost is going to be by the time you finish the project. And
Yeah.
so it could be next month or it could be next year. And so
Yep.
the amount of work oftentimes is the amount of time you have to complete the project. Sooner is better to lock down that EAC, but it is something that project teams have to status every month in order to support the financial reporting process.
Yeah.
The accountants are required to get the latest revised estimate at complete each month. And that is actually a big lift for contractors. So if you have 20 projects in progress, you've got 20 project managers out in the world and trying to get them to pull their numbers together and get those updated numbers to the accounting team. It's a source of friction I've seen for many, many years between the accountants and the ops teams, just getting those numbers in and accurate. It is a big lift. The cost to date is pretty simple for the accountants because that's something that's already happened. And so for them, that's simply reporting the job cost. Billings to date, same thing. The accountants really don't have difficulty getting the billings to date. They may struggle more at getting the ops teams to produce the billings. Typically, the billing process on the prime contract is a project team responsibility. Sometimes they get the accounting department involved in it as well. But generally, it's the ops team that is looking at the contract terms and making sure that they're fully compliant with the billing provisions of the prime contract.
And which of all the things that we put into the WIP schedule, is there one area that you feel tends to cause the most confusion and errors in accuracy?
Contract value is one that, while it might seem very straightforward, there are some accounting exceptions that can sometimes make that a little more complicated to understand. For example, it is permissible under GAAP to generally accepted accounting principles to recognize revenue on unsigned change orders. I actually don't recommend it, but there are times when not recognizing revenue on an unsigned change order could significantly distort the overall financial statement. And so there are times when contractors might do that, and that can create a lot of confusion. It's much easier to think of contract value as being very discrete and very absolute. This is the value of your signed agreements, contracts, and change orders. But to be clear, there are sometimes exceptions to that that can lead to a little bit of confusion.
Yeah, so I want to talk a little bit about preparing this WIP schedule. If someone in the audience today has never built a WIP schedule before, what is the step-by-step process to getting that started?
You want to advance to the next?
Oh.
So how to prepare a WIP schedule. So first and foremost, the key input for your project team to quantify is to calculate the value of what remains to be performed or procured by the team. And the reason I say that is a lot of the other information is known, and it's pretty ministerial to capture and enter onto a spreadsheet. If you've got in my example, if you have $100,000 line item on your prime contract schedule values, the day that contract is awarded to your firm, you've got $100,000 of risk. You own 100% of the risk of performance, the financial cost of delivering that work is all on the general contractor. As soon as the general contractor issues a commitment to a subcontractor, let's say $100,000 in this example, to keep it simple, that risk essentially gets transferred from the contractor to the subcontractor. Uh, from an administrative perspective, we now know the estimated cost at complete for that scope of work is $100,000. And so even at the point where you're paying the subcontractor 50% complete, you know that contractually you've secured that work to be delivered for $100,000. So the $100,000 really doesn't change. What is unknown at any given moment in time over the life of the project is what remains to be procured or performed to finish the work, something that hasn't been bought out, to use the ops terminology.
Right.
And so that's an area of question. And so my question to my project managers is, what do we still have to buy to get finished? And oftentimes that's something that's very close to their top of mind, because they're actively thinking about, what do I need to procure to get finished with this job? We have this, within my business, we talk about buyout velocity. And the faster you can buy out the job, the faster you transfer that risk out of the portfolio of the contractor and to your subcontractors and suppliers, the better off you are on the project. Now, inevitably, there will be change orders. And so the change orders are going to require issuing directives and perhaps negotiating change orders with subcontractors. But the faster these things get done, the better for the company. Once it's understood what remains to be performed or procured, those numbers are entered as on the Flex application, at least. I know there's a job cost statement. It's a little bit different than on the Go application, but within Flex, we call that at risk and contingency. And so those numbers are subjective, and the subjective means that we're relying on the project team to give us estimates for what those anticipated costs are going to be. Once they're let in the form of commitments, it's no longer a mystery. It's now becomes an open commitment, but until we actually transfer that risk to somebody else, that's all our risk as the general contractor.
Right. And if it's something that ends up not being spent, then we do what we would call an internal budget adjustment, and we can go ahead and move that down. We can either transfer it to another cost code and another cost category where we may be in trouble, or we can drop it to our GC's contingency. We can drop it to our profit. We can give it back to the owner, depending on what our contract styles are. But we can make a decision on what to do with it if we have a balance or an at-risk amount that we know we may not spend it.
Yeah, and I love how you describe that. The way moving it down is kind of like what it looks like actually on the financial statement. So ultimately, when you move it down to the bottom line, you're actually saying, this may have been a number that we were carrying in the estimated cost at complete that turns out to be zero or less than we expected. And ultimately, when it drops to the bottom line, it means you're actually going to anticipate a little more profit on the project than you originally estimated.
Yeah.
The next three items on here are really important. And from my experience, the last three items are critically important and often overlooked or underappreciated by project teams. Oftentimes, there's this belief that once they update the at-risk, once they update contingency, their job is done. But the reality is that's all they're doing is they might be capturing what they think the estimated cost at complete, the estimated profit at complete in the backlog. They may have an estimate for that, but what's just as important as quantifying those things is rationalizing the amounts that are actually showing up as over or under billings, for example, because the WIP schedule in and of itself tells a story, but you should think of it as prop's probably the wrong word, but you should think of it as an instrument to help you tell the story. Ultimately, when your surety reviews these documents, they're going to do a very cursory review of it, and it's going to trigger questions in their mind. The real test is the conversation that you have with your surety. So while they're looking at your WIP schedule and you're looking at your WIP schedule, they want you to tell the story that comports with the numbers they see on the schedule and ultimately the numbers that they see on the financial statements. So it's very important for project teams to be able to understand why they have an over or an under billing. With particularly in light of the fact that there's going to be such high scrutiny by the surety at those over and under billing numbers. Most contractors want to be somewhat overbilled at all times. You really never want to be underbilled. Underbilling is uh, creating a cash flow crisis in the future for the company. And so the question that the surety is going to ask is why are you underbilled?
Mhm.
Uh, what they recognize is that if you're struggling to get the architect to agree to progress that is at least as much as the amount you're earning, then it could indicate that you've underestimated your cost at complete. And so that's why sureties get so worried when they see an underbilling on a financial statement.
Well, and doesn't it also, if we're underbilled, it means that we have more costs coming in the door from our suppliers and our subcontractors billing us for work that they've completed than we have asked for from our owner to pay us for that work that's complete. So we don't want to have to owe more out the door than what we're getting in the door from our owners when we submit our GC pay applications. So we never want to be underbilled. We want to be, and we never want to be so far overbilled, like so far overbilled, right? There's also some danger in being too far overbilled. We want to be right on, and we want to be able to tell that story.
Right. Yeah. So an overbilling situation might indicate that you've overestimated your cost at complete. And so according to the numbers, it looks like you're earning revenue at a slower pace than you're billing the client. Um, the red flags that go up for the surety when they see a big overbilling is that maybe there's an issue with a subcontractor. Maybe you've been rejecting the subcontract billings. So
Mhm,
understating the cost incurred to date relative to the work that can be verified as complete in the field.
mhm. Yeah.
And so all these things, have meaning. And so as you explain them to your surety, you just need to have a story that matches with the numbers that they're seeing. The other thing a WIP schedule enables you to do is to measure the amount of money you've got tied up in your project. If I go back to my $100,000 window example for a moment, if you are in a situation where, in fact, you've earned 50%, but the architect only believes you've earned 5%, in the opposite case from my first example, you actually have a $45,000 underbilling. And so that $45,000 may have to come from somewhere, and that could in fact show up as negative working capital for the project. And if you think about the amount of work that a surety will back for a general contractor, it could be 20 or more times their net book value. So it doesn't take a lot of working capital tied up in several jobs to fully saturate the net worth of the business. And
Mm,
so that's one of the reasons that commercial construction is so risky, is because it requires super diligent management of working capital by contractors to make sure that they don't get into a negative working capital situation. Because you may have plenty of work, you may have plenty of profitable work, but if you can't meet your current obligations, you are technically insolvent.
mhm.
And that is not something that your surety wants to see.
Never what your surety wants to see. They're going to guarantee your work, that's for sure.
One of the other things that project teams often forget to do is to look at what has changed from a prior accounting period. So I can tell you when I meet with my project teams, I expect them to understand why the anticipated profit on a project might have gone from $50,000 to 25,000 or 50,000 to 100,000. Like it could be good news, but if I have somebody that says, "Well, that's what the computer says," I think I'm probably talking to the wrong person. And so our financial statements really need to match our understanding of what's happening on the project. And
Mhm.
my expectation of project managers is, they're in charge of the contracts and the financials, and I expect them to really understand what's happening from a contractual and a financial standpoint.
Yeah, on a month to month basis, if we are saying in our subcontract agreement, subs are to have their bills due in by the 20th or 25th of the month, what does that accounting period look like? When is that going to be recognized? When are we preparing our owner bill? And so being able to filter down to what's happening in any given accounting period is really important, like you're saying, of, well, what changed from the incoming of invoices this pay period versus what we're paying our owner and happening from pay period to pay period.
Absolutely. And things like, getting change orders resolved and settled on a
Yes,
timely basis, like
yes,
allowing them to stack up is just a giant mistake.
yes.
It makes it harder and harder to manage the work. And you're going to get into a situation, I know on AII contracts, you're permitted to bill against construction change directives, but as a practical matter, owners resist paying those things. And architects don't always jump in the way they're expected to. And so we just have to be on the ball and make sure that any open change order issues are resolved as quickly as possible.
For accounting periods and revenue recognition, how do WIP schedules connect direct connect directly to that revenue recognition in compliance with industry standards?
So, as we discussed, the billing, you might be billing 50%, but only have earned 5% on a particular project. So there's a difference, there's a variance between the amount you're billing and the amount you're earning. And so in order to reflect that on the financial statement, you need to book what's called a revenue adjustment entry. And so that revenue adjustment entry is going to adjust the amount billed down to the amount earned. Ultimately, what all your financial partners want to see is the amount earned. And so the difference between the amount earned and the amount billed ends up being either an asset or a liability, either an overbilling or an underbilling. And so it's going to be carried on your balance sheet accordingly. And the WIP schedule, if you'll notice that people have a lot of different formats and different columns, but once you're accustomed to looking at a WIP schedule, you're going to be looking at the revenue, you're going to be looking at the overbilling and the underbilling, and those two columns are going to tie to the balance sheet accounts on the financial statements.
Mhm. What mistakes do you feel like you see GCs make when the period closes?
The biggest mistake is not having updated EACs. And I get it. It's tough. If you look at, I talk to sureties quite often, and they talk about getting financial statements from contractors within 3 months of accounting period close is something that sureties say is probably typical. I will tell you, as the owner of a commercial construction company, looking at a WIP schedule 3 months late is almost a waste of time, right? The half-life on a WIP schedule is actually quite short. And so in order to get the most out of having a WIP schedule, you need it to stay current all the time.
Yeah.
And it helps you manage the cash flow and the profitability of the business on a day-to-day basis. And if you're only looking at that once a quarter, you're really flying blind. And
Mhm.
so, that's why, producing the WIP schedule is such a critical part of what we do from the Flex and the Go platform. These are the tools that help contractors run their business on a day-to-day basis. And oftentimes they recognize that, but there are just so many challenges in getting the information organized so that you can produce it on short order. And it's something that, we advocate having live all constantly, being continuously updated so that it can be essentially viewed on the dashboard, so that construction company owners and managers and executives have a real-time look at profitability, and over and under billing and backlog. And those are the numbers that, quite frankly, the surety expects you to have on the top of your head. And when you do have that, it's completely transformational in the way you manage your business by the contracts and by the numbers.
I want to transition us a little bit into talking about how Red Team handles handles the managing of this WIP schedule. So I wanted to see if you would tell us a little bit about how the softwares that we provide here at Red Team automate WIP reporting and what problems that solves compared to spreadsheets.
Well, some of the key capabilities using good software is that we can pull in all the information that's known. And so we don't impose the entry of data by project teams that is essentially information that's already in the application. So things like a subcontract agreement, to the extent that it's 50% paid, like the actual costs, the billing, the collections, the disbursements, all of that is already reflected on the WIP schedule in real time. And so it just reduces the number of moving parts that have to be touched by project teams on an ongoing basis. The systems also update budgets as change orders are executed. It's another area that it's just one less thing that project teams have to do manually. So automating all those workflows is critical. Even updating on the Flex platform, updating at risk and contingency is somewhat automated as you buy out a project and you issue commitments. Users are prompted to adjust the at risk and contingency amounts right at that moment. It's when those numbers are on top of mind for project managers. You know, they understand what scope they've just procured. They understand if there are any gaps in it, and so they can carry amounts in contingency or at risk as needed. And by doing that and staying on top of it every day, it means that the WIP schedule is always up to date. And when you have an up-to-date WIP schedule, the benefits are just enormous. It gives you that maximum control over cash flow and working capital that your financial partners certainly expect. And it keeps your team focused on the factors that affect overall financial performance, like really looking at profitability of each job, not just at the end of the job, but over the life of the job, and understanding how that contributes to your financial statements. And most of all, this is the way, you know, having an updated WIP schedule and being able to tell a story that comports with the numbers on the schedule and on the financial statement, that's the key to building trust and confidence of your key financial partners. And while that might include your bank and your insurance company, in some cases it does, it most certainly includes your surety that is taking a very large risk on backing your business. Like I said, could be 20, 30 times your net worth. And so that's a key partner to keep happy at all times. You want their affirmations of your capability as a contractor, and you want those bonds when you need the bonds.
Well, and we're talking a lot about that too, with being able to provide these reports to our banks, to our sureties, to our bonding companies, but also what does it do internally? If we have our project managers primarily responsible for maintaining the WIP schedule, entering in their costs to complete, making sure that they are looking at this and taking action on a daily, if not weekly basis. They're in there on a fairly regular basis, but what does that do you think for the executives within the company when we're taking a look at these reports internally within our company for the executives and for the project teams? How does this improve visibility for those internal teams?
Well, first and foremost, I would say, someone told me this a long time ago. You can't expect what you don't inspect.
Hmm.
And putting, having everybody speaking the same language and everybody able to look. And when I say everybody, I'm talking about people throughout your organization, your project managers, your project engineers, your project executives, having everybody understanding what's on the financial statements, what's on the WIP schedule, gives you the ability to have a live conversation about the success of the business on an ongoing basis. And when everyone speaks that same language, it simplifies and enables you to actually measure your financial performance in a way that makes that like realizing the potential for what you have on your books, realizing the potential from a financial standpoint is key to the success of the business.
Well, it just gives you that real-time ability to make important decisions within the business. If those are up to date where they should be, and we have a clear line of sight of the profitability within each project, if I'm the owner of a construction company and I need to go buy 3 new trucks, if we're not keeping up to date with our job costs and our WIP statements, we can't make a clear decision on, do I have enough money to go buy 3 trucks, or do I have enough for one, or do I have enough for none?
That's
That,
right. That's
yeah.
right. Like knowing working capital is a critical one, like just knowing where the money is.
Hmm.
Uh, I've had my non-financial business partners that would be how they would ask. They said, "Where's the money?" And if you can look at your financial statement, you can see your net worth of your business, then you can look at your bank balance. And you can say, well, those are two different numbers. And why are those numbers different? Well, the amount you have tied up in working capital, it really tells the story of how you get from net worth to your bank balance. And having that level of insight on a day-to-day basis gives you the ability to make those decisions like you're describing, Tracy. Like, do we have the capital to invest in equipment at this moment? Or is all the capital tied up in working capital on jobs in progress?
Right.
And could even be worse. We could have more working capital in jobs in progress than we have in net worth, which means at some point we've probably tapped a line of credit somewhere to close that gap. And so
Yeah.
being able to understand that and see that in real time gives you the confidence to make decisions.
Okay, I've got some audience questions that I wanted to throw your way if you don't mind.
Absolutely.
Okay, so we've got a question about time and material projects. Annette is asking, should all time and material projects, including construction management, CM not to exceed, be set to revenue equals build?
That's what I recommend because time and material contracts, there's really no uh, you might have a not to exceed amount in your contract, but at the end of the day, the terms of the agreement are entirely flexible. And so what you're entitled to is the work that you've performed and billed. And there's really no way to say that you're going to get the future work because at any moment, the owner can say, you know what, I've had enough of your time and material billing and I want to stop it today. And so that puts a hard end to it. So it's not vulnerable the way lump sum or CM contracts are, where
Mm-hmm.
you've got an expected maximum contract value and a period of performance that can often span multiple accounting periods. And so you don't have that kind of uncertainty that you have to close with percentage of completion calculations.
Got it. And there's one more, or I got 2 more questions. One is, um, remind us how to break out prior year audited revenue in Flex so that we could report calendar year revenue.
That's such a great question. So it's probably a little bit beyond today's webinar, but definitely when you've got financial reporting, typically and oftentimes if you have audited or reviewed financial statements, your CPA may be coming in and booking adjustments to the closed fiscal year while you're already operating on your next year. And so it's not uncommon to have to go back and adjust prior year over and under billing and revenue recognition for a closed period. And so whatever adjustments you make to that prior period are going to be caught up in the current year. And so it's another reason to make sure these documents are completely accurate. So if you over recognize income in the prior year, you may have to, and the reality of that over optimism catches up to you in the current year. You could in fact have a reduction of revenue in the current year, which will show a financial impact in the current year that is the result of having been over optimistic in the prior year. And so on the Flex platform, there is a prior year adjustment option. And so you can go in and adjust the prior year based on perhaps the opinion of your CPA on an audited financial statement or a reviewed financial statement.
Okay, I've got another one. So example, we have trouble balancing financials with the WIP report on a monthly basis for the auditors because it is real time. Is there a way to run the WIP report with past date versus real time?
So in Flex, currently there's not. And that has actually been requested several times. I actually think it's a great idea. The risk is that you've got aging estimated cost at complete that won't necessarily be apparent when you're running a final WIP schedule for an accounting period. But we do allow you to close accounting periods within the Flex application. And Tracy, I'm not sure how it's actually done on the Go application. Perhaps you can explain that.
Well, I can explain it in that we don't set accounting periods on the Go side.
Okay. Well, that'll explain it.
Explain.
Yeah, so on that has been requested. I actually think it's a good idea.
Yeah.
And I know it is in our backlog of awesome ideas that we would love to have.
Yes, and Meredith, if you send us your company name, we can go find that suggestion and add your company name to it. We'd love to do that. Annette is asking, isn't latest and best the rule for contracts and EAC?
I'm sorry, say it again.
Annette says, isn't latest and best the rule for contracts in EAC?
Yes, that is generally the case. And so and I've heard this. It's often misunderstood. Like sometimes I've seen people think what should be on their WIP schedule should be the estimate at complete prepared during that accounting period. And actually, that's not true. So if you're closing, let's say you're closing a fiscal year and your auditors, for whatever reason, didn't get out to your office until April, which you would be using to calculate the revenue in the prior year, is your latest revised estimated cost at complete, which is in the current year. And so latest and best is what the questioner is asking about. And yes, that's absolutely true. You should use the latest and best, even if it's calculated in April, you should use that for computing your percentage of completion and your revenue for the prior fiscal year. That's a great question. That's definitely a practitioner's question right there.
Yes, it is. All right, well, as we get ready to close, we've got about 10 more minutes. So I wanted to have some time for some closing takeaways here. And thank you guys for submitting questions. It always helps us when we're able to answer some live questions for real life scenarios. So thank you so much for those of you that submitted those questions. But for contractors listening in today, what would you say is the single most important thing they should do differently when it comes to WIP schedules?
I think I would say setting expectations that this is something, it's part of running the business day to day. I've heard contractors talk about some of these things as quote unquote paperwork, right? And yes, we're creating documents and it's numbers on paper, and maybe it's not as fun as erecting things on a job site. But the reality is, this is essential to the business of construction. We're very oriented to contracts and financial performance, and you really can't separate these from the construction activities themselves. And having things like real-time work in progress schedules, and a team, your entire team of people who can look at it, understand what they do and the decisions they make, how those things affect your financial performance. it's really nothing short of transformational for your business. And this is it's a team sport, what we do.
It is.
And so having everybody on the same page, speaking the same language, is really the only way you can get the financial results that your team expects.
Yeah, and I feel like that helps. We can tell when we've had conversations with our companies where those two departments between the accounting and the project management ops team are humming really well. You get that synergy and that excitement that stays ever present. And that's such a neat environment for us to walk into is when those things are are happening in real time. And you've got that real communication that is transparent. Everybody knows what's going on. And those are always fun offices to walk into when they've got that synergy and a real understanding between everybody internally that's involved in that process. It's not just the accountant's responsibility, it's also the project manager's responsibility as well.
And Tracy, you and I have both worked in environments before this technology existed, right?
Yeah.
And I'm sure, my experience goes way back farther than yours.
Yes.
But I can tell you that in the old days, when these things were very opaque, there was a lot of friction and tension
Mhm.
between those two
Mhm.
departments. And so I quite honestly, I just don't see that anymore, right? Just having the visibility enables people to work better together more effectively. And so, that's why we do what we do.
That's why okay, and that's going to lead me into our next question is how should a GC know when it's time to move from manual methods to an automated WIP reporting system?
If you can't do your WIP schedule by memory, it's time to have an automated system,
Mm,
right? Literally, if you have one job, I know my ops people, if they had one job, they just remember all the numbers off the top of their head. But you have, 10 or 20 jobs, there's no way, and on an aggregate basis, I've seen this among our clients, at 10 million in aggregate volume, which is really not that much, the wheels come off, right? It's too many things to try and manage manually. And so you definitely need an automated system because otherwise you're not going to have that real-time work in progress. You're not going to have that ongoing dialogue among all of your team members working towards the same financial goals until you automate those processes.
yep. And lastly, what resources or first steps would you recommend for teams wanting to improve their WIP accuracy right away?
Um, Ownership, right? Expect ownership of the numbers. Expect that your project teams can explain their over under billing, their use of working capital. These numbers on the Flex application, we have something called a financial overview,
Mhm.
which summarizes net working capital and cash flow. And your team should speak the language that are represented on those statements. And it's not quote unquote the accounting department's responsibility. It's the project team's responsibility to understand where they stand financially and contractually. And so that, setting the expectation is probably the most important thing you can do as a leader in this business.
Awesome. Well, thank you, Mike, for your time today and helping us to learn to understand the WIP report a little bit more clearly. Sometimes I know it can be like something that we don't talk about enough to where the terminology isn't top of mind. And so we wanted to take the opportunity to dive into some of the terminology and talk about it in a way that everybody can understand. So if we can help you at all with anything to do with Red Team Flex or Red Team Go, helping to streamline and automate your projects, we would love to do that. Feel free to scan this QR code. You can schedule a meeting with us, and we'd be happy if you are somebody who does not have Red Team yet. we would love to talk to you about how we can help you set up your project budgets and how we can help you go through the buyout process and set up your construction schedule and automatically build your WIP schedules for you in your day-to-day management of your project tasks and all the expenses coming in the door. It's something that we love to do, and we love to help our companies with these parts and pieces of a project. They're the most important pieces. Do we do RFIs and submittals and scheduling? Yes, we do. But where does Red Team shine? We shine in the financials management area. So we would love to talk to your team and help you with the automation of your projects. With that, we are going to conclude our webinar today on the WIP schedules. If there's anything that you need for existing clients, if you have any additional questions and you would like to follow up with us, please don't hesitate to reach out. If you want to contact your client success manager with some questions, we can schedule some calls if you have any additional questions that we didn't maybe get to answer today. But we hope you have a great rest of your week. Thanks for taking time out of your day to join us today. We really appreciate it. And we'll see you on the next webinar. Thank you so
All
much.
right. Great. Thanks, everyone. Thanks, Tracy.